What's going on, everybody? Michael Silva here. Look, at when this happens, the Fed typically pivots. And I'm going to talk about that on today's episode and get to some really interesting charts overall. Before we do talk about specifically what that is and what happens if they don't step in, let's talk about that CPI report that came out. Higher than expected, highest since 1981, 40 years, 8.6%. Holy moly, we did say that we were walking into a wall of events that were taking place, and that was a big move to the downside. Almost two standard deviations outside of its weekly expected move. I was thinking we'd get a lower high and lower low. We got that, but it went a lot lower than what I thought it would do. Next week, we also have a lot of stuff like OPEX. We also have the Fed meeting, so all eyes are going to be on the Fed going into next week. So be aware of that. Monday, maybe Tuesday, right? It might be kind of calm up until the announcement, okay? Now, how did the S&P 500, how did the products do? Well, on the daily time frame, clearly red across the board other than the VIX, right? All 11 sectors were down, but we did have defensive names. They were the cleanest shirt in the bunch there. As far as weekly time frame goes, holy moly, big down week, right? Nasty weekly candle, which we'll show later. But yeah, Dow Jones Industrial Average was down almost 5%. S&P 500 was down 5% on the week, which doesn't happen all too frequently, right? I think we had one recently here in 2022, but before that, it was the closest one, I believe, was the pandemic. Nasdaq Composite was almost down 6% on the week. Nasdaq 100, same situation. And then we had the Russell 2000 almost down 5%. So some big hits in these index products. Now, if you look at week-to-date performance for the 11 sectors that make up the S&P 500, the biggest ones that were down on the week was XLK and XLF. So, two of the three horsemen, but XLY wasn't too far down. When that is the case, you have consumer discretionary, you have tech, right? Financials, these are some big sectors. When they are the big laggards, it's going to be very hard for the market to perform. Overall, every sector was down on the week, okay? But what performed the best? Consumer staples and energy, right? Energy, by a long shot, actually. Consumer staples was still down 2.57%. Even utilities took a big hit, down 4%. All right, so I showed this chart a while ago, and this chart right here it was showing, somebody, Mark posted this chart, and that was without all the annotations. But this was showing like, hey, we could be finding a bottom right here, right? There was so much bullish behavior before these last 2 days of dropping, right? There was this thing, what's called a New York Stock Exchange upside volume of greater than 80% with 3 consecutive sessions, which is pretty bullish for the most part. But what I pointed out was, because I noticed these red dots all line up with something. I'm like, okay, well, every red dot here on the screen, when this happened, it happened at some sort of Fed pivot or Fed intervention of some sort. Okay, so, what am I talking about? Well, we had QE Unlimited, right? This was the China stock market turbulence during all that craziness that was going on. Operation Twist, QE2 was announced. On this one, Bernanke hinted at QE2 over here. And actually, right here on this rip-up, that was when QE1 was announced during the financial crisis, but then it was expanded upon, obviously, down more towards the low. And what I pointed out was, okay, well, it happened again right here, and it also happened here, and the big similarities between this one and this one is the Fed didn't intervene on these two. This was the only oops, and then we saw a bigger hit to the downside. And right now, what we're seeing is another hit to the downside. Why? Well, we haven't had that Fed pivot yet. So that's going to be important to watch. All right? We'll get more into that. What's like worst case scenario, right? So I'm looking back at these previous big time crashes, not the pandemic, right? That we had, there was a big drop, a lot of fear, but it was 3 weeks, 4 weeks, and it was done for, right? We just started ripping back up. Here, where we're at right now, we're seeing like 7 consecutive weeks in the red, right? In 2022, it's like we've had just a couple weeks that were in the green. But okay, so worst case scenario, right? .com bust, it went down 51%. Great financial crisis. The financial crisis went down 58%. So I'm like thinking to myself, okay, so what if we do have another crisis on our hands, right? And it seems like that's always a possibility, right? You can't rule it out. But what would the levels be if the S&P 500 were to drop like that? Well, 50% would take us to just about the pandemic low, just slightly above that, of around 2,400. That would be a 50% decline in the markets. All right, you got to wonder, is the Fed going to pivot at that point, or are they going to keep on trying to fight inflation, which it's already at, a very, very high point? Well, we'll see here because they seem very serious about continuing their path of tightening. And then I thought, okay, what if it was even bigger? Let's just mark it up where this prior area of resistance, then we broke out, right? 67% decline, that would be crazy. I'm not forecasting that, but let me just say that if the market were to tumble down there, there'd be a lot of pain everywhere. And if you are able to withhold your capital, that would be obviously one killer entry in my opinion. But now when I say that when this happens, the Fed usually steps in, what is it that I'm referencing to? Okay, so I want to bring up a quarterly chart here, okay? Quarterly chart gives us some really interesting data when you use a 5-period EMA. And what I want to call out here is these blue movements right here are all pointing to a quarterly candle close below the 5 EMA. And every time that we had a quarterly close below the 5 EMA, QE2, Operation Twist, the China stock market turbulence, the repo crisis, all right? They're Fed pivots, QE Unlimited, a Fed pivot. Now, the times that we didn't have a Fed pivot out of the gates on a week, on a quarterly close, right? The June is not over. We could finish above, the quarterly 5 EMA. We still have, quite some time. We'll see. But you can see here, when they let that take place, there is some further downside in the market. So if there is no Fed pivot, right, very similar like this, to see what we're seeing right now, that's already a big quarterly close or big quarterly candle to the downside. So if we do close beneath the 5 EMA, you look down, you look over here, right? This is the 2008 financial crisis. What took place? Well, we had a big green candle, then a hammer candle, another red hammer candle, and then we had that quarterly close, and that's when things took off to the downside. Okay, well, we had this big green candle, we had the hammer candle, big quarterly candle, red one right now. Same thing here, right? We had this big blow-off valve quarterly candle closing basically at the high. We had a couple hammer candles, and then we finally closed, and then we closed again, and then we closed again, and then we closed again. And it took a while for, the Fed to step in. But this is very interesting data because we are right now below the quarterly 5 EMA. So what would have to take place here that I'm thinking is some sort of Fed pivot. So if the Fed pivots, that can very well keep us just having a 1 quarter, maybe 2 quarters under the 5 EMA and save us from something like a 50% decline in the markets. Okay, but if they do not, and we keep fighting inflation, we're in this stagflation environment, or if we're tightening into an economic cycle of slowing growth, it could get very bad. Now, another correlation that I found interesting between these 3 periods in time, right? .com bust, financial crisis, and then what's going on here is this chart right here. I've shared this before on Twitter. I talked about it on the interview with Michael Gayad, but this right here is interesting. So in short, when the bonds they begin outperforming commodities, utilities typically begin outperforming the S&P 500 on a relative basis. But as of now, utilities are outperforming the S&P 500 at the same time that commodities are actually outperforming bonds. And what I find interesting here is if you look at a monthly time frame and you put a correlation, it's very rare for a 1.0 correlation, which means they're moving hand in hand. So I pull this up and I'm looking at the chart. I'm like, oh, whoa, last time we had this type of correlation was 2008. The time before that was also, going into the .com bust. Not to say that this is going to be the case, but as we know, the market and the intermarket kind of perspective that's going on is very, very interesting. As the market's been moving down, there has been no capitulation, and the bond market hasn't been a flight to safety. It's been also very weak. Okay. Another thing that I want to point out that I've shown before is a monthly chart of oil. And if you don't know this, oil the spikes in oil have led to the starts of bear markets. So for example, the 1987 crash, 1990, the .com bust, financial crisis, and what you see here is a rate of change. I'm using on the monthly time frame, a 12-period rate of change. And what you can see taking place here as oil is flying through the moon, we're getting multiple spikes above this level over here, which we don't get to frequently. It I mean, you would think that there's going to be some repercussions, right, at some point. Now, I will say this rate of change just came down a little bit. It was earlier up at around 100, this peak here. So it is backing off a little bit, which could indicate that the rate at which oil is moving up on a monthly basis is going to potentially begin slowing. It's already at a high level, so it has a way to drop. But just be mindful that the rate of change, if we start getting a little bit lower here, could very well give us a signal that we may see some pain ahead. Okay, and if you look at something like the cycles of both the stock market, and which is the orange, and in the blue, which is the economic cycle, you can see here the 11 sectors that make up the S&P 500. And you can be like, okay, at the top of a market, what's typically performing the best? And that right there is energy. And what has been performing the best year to date? Energy has been performing the best. Okay, well, what happens when the market starts to turn? Well, consumer staples and utilities. And as we know, year to date, it goes energy and utilities as the top two leaders. And then you can see here when that takes place and we start rolling, right? Guess what happens later on in the cycle right here? This is the economic cycle. You can see that later on, all of a sudden, this starts curling over into giving us a warning of an early recession. And as we know, the 10-year yield and the 2-year yield, they have already inverted previously. Now that I believe that they're standing almost at inversion, it went down today on the CPI report, but I believe the spread is at 0.09. And obviously, when you get to negative, that is when you get the inversion. Okay, so some interesting data, right? I hope that gives you obviously some insight looking at these larger time frames and how the Fed is kind of intervened every single time we have a closing quarter below that 5 EMA. So if they don't intervene, hey, you gotta just be very careful here. As always, right? Now, the S&P 500, as we stated, 2 deviations outside of its weekly expected move. That is nasty. Very, very nasty on this report. Big volume, right? We've been talking about this, though. We've been talking about the contraction leads to expansion. All right, so you got to take these expansion type of moves very seriously. If you're on the wrong side of it, you got to manage your risk. And this is what happens when you get outside of weekly expected moves. Not only the weekly expected move, but yesterday I talked about the CPI expected move. And we basically traded the entire day outside of that as well. So some wicked sell side activity there. But overall, I mean, if you take a look at the VIX, it didn't even get above 30, right? We closed, which is still high for the most part, 27.75. But man, this has not shot off. And I've shown charts before where if you look at, prior bear markets, they typically capitulate at some point where you get the VIX spike above 40 and we haven't had it. And that has me a little bit on edge. So that's something that we got to watch out for. Now, I will say Nasdaq volatility, it is still in the 30s. Russell volatility is still in the 30s. So this is, once again, not, child's play type of market. You got to be very careful and watch your capital very, very closely. If we take a look at the SPY weekly expected move for next week, this is pretty wild, right? So we're looking at a $13 expected move, which is roughly 130 points on the S&P 500 on the SPX. So we have a bigger range, and that can take us to a low of around 375, which would be about a minus 3% move. So we're talking minus, 3.4% to the downside and plus 3.4% up to the upside as far as expected move goes. That is a big range, which can allow for a lot of volatility going into the Fed meeting, right? I don't think that Monday, Tuesday is going to be all too wild. I think we're going to, just like right here, how we kind of just went sideways into the CPI data, and then at the end of the day, we sold off like, hey, who got that information leaked to them? And then bam, the data came out, and then we got that bigger hit. Well, I think that we're going to have something similar, right? I'm not going to make any trades based off of my thought of this, but Monday, Tuesday leading up to the Fed meeting might be calm, and then maybe even we'll see, right? If what happens into the close on Tuesday before the announcement, which I believe is on Wednesday. I have to now check on. But yeah, like I said, right, we've been going sideways into this wall of stuff. So be mindful that with the Fed meeting and OPEX, right, it's all coming into play right now. That breakdown did occur on big volume. So that is a distribution type move. What can we potentially expect? Well, it definitely seems, right, lower highs and lower lows, it's now probability that we can potentially come and try to take out these lows, right? That's definitely in the cards, especially at the lower range. And what does that line up with? That lines up with seasonality, right? Seasonality, what we pointed out on a prior episode, you actually sometimes get an undercut in June from the May low, and then you get this kind of rip and move, and then it kind of like goes everywhere. But then October and the back half of the month, back a quarter of the month, the end of the year, typically you start to see a little bit more movement to the upside. So we'll see if that's the case, right? I'm not going to rule it out. I'll constantly watch it, but we'll see, because every day there's more data. What would get me a little bit more bullish too in the short term? Well, housing index getting above this upper trend line. You can see here we talked about it. It was holding his resistance and it was just going sideways. It looked like it could potentially do it. You know, gave some encouragement here as it consolidated, but bam, it got hit, and it got hit hard to the downside today, down 4.34% for the housing index. So that does not look good. And then HYG, high yield, right? We talked about the resistance coming into it. I closed out my short position. I think I have a little bit left, but for the majority of it, even more than 2/3, I closed out. And I was shorting here, and then I shorted a little bit more up here. It would have been great if I would have just shorted up here, but that wasn't the case. But you can see, you know, about a 3% gain on that. So what I was calling out here is it did make a new low, which the S&P 500 did not. So that might be giving us an indication that, hey, we could very well potentially get a low. Now, we didn't get a closing low, right? We didn't get did we get a closing low? It's close. It's very close. Yeah, I'd have to look at it now, look it up closer. But just be mindful that we did create a new low, right? A wick down there. Now, let's take a look at oil, right? On the daily time frame versus the monthly time frame. It held up rather well today. It was only down 0.69%. It held up rather well, especially comparatively to like the energy sector, right? So we'll see here if this wants to consolidate and potentially still head up higher. That's always a possibility. But as it stands right now, just be very careful here, because it's still in bullish context. As much as you might want to be shorting it, it's not the short trade at this particular point in time. Let's take a quick look at gold over here. Gold is acting like it should, right? Up 1.23% on a day where we were really risk off. So gold came in nice and strong, big hit of volume right there too. It could be popping through this little inverse head and shoulder pattern, but overall it is in just this kind of down channel here since March, right? We had this, you know, blow off move right here, and then you could see it's been ping ponging around. If it is a inverse head and shoulder and we meet a full measured move and it breaks out of this channel, I would expect 1980. That is a full measured move of this inverse head and shoulder, and that actually lines up with this prior area of resistance. So if you are long gold, that'd be a level that I'd be keeping a close eye on going forward. Also to note is the dollar went up in a risk-off type move. When the dollar flies up like this, well, guess what happens? S&P 500 went down, right? That's what we've been talking about here. Now it is coming into its upper Bollinger Band and a previous high right here too as well. So that could potentially act as a level of resistance, which might slow down the S&P 500, or potentially if it comes off hard and fast, it might actually bring the S&P 500 up. So you never know. We get this undercut and then it rips and the dollar comes back down. We'll see. We'll see what happens, right? As it stands right now, this is an expansion type move. I'm looking for areas to potentially go long in, right? I covered some of my shorts. I got rid of some of my longs up here, moving on the way up. And now I'm just ready to start kind of getting back into the market, but from a long perspective. But really, I need to just see some sort of some sort of consolidation, some sort of strength, something step in order for me to feel a little bit more confident given the current market environment that we discussed. Looking at the weekly time frame, we close at the weekly low. This weekly low actually is the lowest weekly close for 2022 by 50 cents. So we had a new closing low on the week for 2022 by 50 cents. Crazy, crazy, crazy close to the downside. Still below a declining, everything is declining as far as a moving average perspective, but we got the 30-week, 40-week, which is basically the 200-day, the 10-week, which is about the 50-day, and then we had the 5 EMA also declining. So to be more bullish, we need to break above the 5-day. We need it to incline like we saw here, but we need to actually hold above it, and we just clearly did not. This is actually somewhat of a morning star pattern, right? A big bullish candle, and then it consolidated, and then a huge red candle to the downside with a new low. That is a very bearish thing, indicating that we might have, we might gap down on Monday or push a little bit lower here, potentially even test that low come next week. But like I said, there's a lot of things taking place. OPEX, we typically have the June kind of lull here, all right, and then we have the Fed meeting. Now, I didn't show the weekly ranges for the Qs and the IWM just to keep today's weekly recap a little bit more compact, but if you want to take a look at it, this is into week where it closed. This is the plus or minus range. This is the upper range, and this is the lower. Just screenshot it. I got the Qs and the IWM and the SPY right here, and these are those levels that I will be watching going into next week. That's all I got for you on today's episode, everybody. Have a wonderful